The sell-off in technology stocks continue. The latter is encouraging some rotation toward the non-technology pockets of the market, but the re-escalation of the Middle East tensions threaten that trade as well, as the latest rebound in oil prices this week is lifting global bond yields along with it, threatening to reverse the recent easing in inflation and hence the central bank expectations. With geopolitical risk back in focus, we could see volatility rise on headlines in the coming hours and days. So welcome to Swissquote's Daily Market Talk. It's Wednesday, 8th of July. I'm İpek Özkardeşkaya. We will talk about the space and earth economics. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the sell-off that started after Samsung announced jaw-droppingly good and, more importantly, better than expected results continued in the following European and US sessions yesterday. ASML in Europe, for example, lost more than 7% in yesterday's trading session, while VanEck Semiconductor ETF in the US fell nearly 3.80%, slipping below its 50-day moving average for the very first time since April this year. The technology-heavy Nasdaq 100 index led losses among major US indices. It lost 1.77% and closed a touch below its own 50-day moving average. And its brand new member, SpaceX, tanked 6.83% in its first day in the Nasdaq 100 index. The stock price went straight down and closed below the post-IPO opening price of $150 per share. Now note that yesterday was also the end of the quiet period for SpaceX. Wall Street analysts started revealing what they thought about the company and where it's headed. And it blew my mind to see that the views went from bullish to extremely bullish. Goldman Sachs and Citi analysts, for example, set their price target for the next 12 months to around $200 per share. That's more than a 30% increase of its value from yesterday's closing price. Deutsche Bank expects the stock price to rise to $255 per share, a 70% rise over yesterday's closing price. And Morgan Stanley is expecting the price to go all the way up to $300 per share. That would be a 100% increase compared to yesterday's closing price. Morgan Stanley analysts say that they believe SpaceX can convert energy into intelligence at scale with optionality to monetize through a range of consumer and enterprise solutions for the next era of AI, while also saying that there is still considerable uncertainty about companies' prospects. And this part is more interesting than their average price target, in my opinion. Morgan Stanley analysts actually see SpaceX price range from $75 per share to $600 per share. It's quite a gap. I think that if SpaceX can pull off the orbital data center business, it would indeed mark a turning point regarding the AI infrastructure's future. But on the other hand, the company must spend loads to get to that point, to get their data centers into the orbit, and it seems like the cash that the company will burn is not being taken seriously into account when setting the price targets. I'm not saying it is a hard task to set a price target for a company that promises a revolutionary business. That's the promising part. But the bad part is that this business doesn't exist just yet. It is overly ambitious. It will be overly costly, and SpaceX existing and money-making businesses like Starlink, for example, and the data centers have so far not been able to finance their costs. Now, selling computing power to compute-hungry AI companies could reduce that gap, but we don't know. So we are watching SpaceX. We are all watching. Meanwhile, on planet Earth, things are souring again. Tensions in the Middle East have increased a notch this week after Iran attacked ships in the Strait of Hormuz, remember, to which the US actually answered with retaliatory attacks. What a peaceful peace negotiation period. If I understood well, Iran is now reportedly laying mines through the Strait of Hormuz, which would obviously force ships to pay for their security because only Iran knows where the mines are, and even after the peace deal is inked. Yes, that would be a terrible long-lasting consequence of a unnecessary war that brought strictly nothing to anyone except for Israel's very own geopolitical and political interests. Now, this is not a geopolitical or political podcast, so I won't comment on the geopolitical dimensions of the extremely complex story, but I can say that the peace talks are looking to be in jeopardy today if you add to the mix the nuclear ambitions from both sides that do not meet each other. The US is asking Iran to scrap its nuclear program, while Iran is saying no interest whatsoever in doing so after being so wildly attacked by US and Israel do. So the part that interests me is oil prices. US crude rallied more than 5% in yesterday's trading session on these renewed Middle East concerns, and it is consolidating gains above the $72 per barrel level this morning. At the time I'm talking here, it is too bad because the oil market has just returned to contango, meaning that spot prices turn lower than future prices. This is the normal state of oil markets, mind you, because oil has storage costs. So if you buy oil today, you have to store it somewhere and it costs money. Therefore, if you buy oil today rather than buying it tomorrow, you would want to pay cheaper price for it. This is the normal market structure. But this market structure flips in times of stress and scarcity. In the latter situation, buyers prefer buying oil immediately today, scared that there would not be enough oil in the future or it would just cost more in the future, resulting in spot price exceeding future prices. This is exactly what happened during the Iran war weeks. The further the maturity, the lower the price compared to the spot price. Again, the market turned contango by mid-June and could stay there if Middle East tensions do not escalate further and if the stress in oil markets remain contained. And as per oil prices, the $75 per barrel level for the US crude, which is the 200-day moving average, looks to be the next critical resistance. In case of de-escalation of the Middle East tensions, though it is unclear how low oil prices could go from here, because the pullback was supported by the supply side of the story, yet there is the other side of this equation, which is the demand. More specifically, what will China do? Because China cut its demand very sharply during the Iran war as prices went up, and according to the Financial Times, it just started tapping back into the international markets to replenish its oil reserves as prices fall. The good news is that China looks to have enough reserves, so if prices rise again, they could just stop buying. But the bad news is, if oil prices rise again on geopolitical uncertainties, the recent softening in inflation expectations would rapidly reverse and force global investors to return to their hawkish central bank expectations. And that's not good news for the global market appetite. Because that global yields rose sharply in yesterday's trading session, along with the rally in oil prices. A benchmark for the European 10-year yield spiked past the 3% level. The US 2-year yield, which best captures the Fed expectations, flirts with the 4.20% level again this morning, as the Japanese 10-year yield advanced to 2.87% level, which is a fresh multi-decade high. As such, equity indices are about to come under renewed pressure if the tensions in the Middle East just don't disappear quickly, increasing the risk of a pullback from fresh all-time high levels for some of these indices. At the time, technology investors also walk on a tightrope. So today, investors' attention will be shifting to the latest Federal Reserve minutes. But given how fast the headlines change today, I think that whatever has been said in that meeting is already outdated. I mean, remember, the rising US inflation was a focal point of that meeting, but since then, the Middle East tensions ease and the US crude nearly halved from its war peak of $120 per barrel level to below $70 per barrel level this month, also easing inflation expectations. And today, the peace deal between the US and Iran is in jeopardy again, and oil prices is rising again, fueling inflation expectations. As such, geopolitical headlines will likely determine the market sentiment over the coming hours and days. A further deterioration in the Middle East situation could weigh further on equity valuations, along with the rising stress in technology. Note that the Kospi index is down by another 5.74% this morning, down by more than 20% since its June peak, hence stepping into the bear market. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.